So you want to grow your tiny little trading account into a big boy trading account, huh? Okay. I get it, yeah, we've all been there. You want your account to go from a itty bitty baby to a whoa there, Mandingo, because size does indeed matter. And now you want to know how to create that Born Vita so your account can grow big and strong. And if you didn't understand that reference, then you might not be Indian, which is fine because we could just pretend that it's Pediasure. Grow and gain. Real vanilla. It is super vanilla. Either way, you are in luck because I got some answers for you in this video. But make sure to listen to all the steps that I'm about to talk about because they fit together. You can't just do one of the steps and then hope to win. They all gotta combine for the synergy. And before we get into it, I gotta tell you about the explosive stocks checklist, which is a strategy that our team put together that actually works amazingly for small accounts because you're getting into some of the most volatile stocks you can find. That's how they explode higher. And how convenient is it that I have a free checklist for you in a video about growing a small account? The serendipity is unbelievable. There's a link down below in the description and comments. You could go download that today. And the volatility that I'm talking about that you need to grow an account, well, we're about to talk about that in a minute. But the first step you need to do in order to grow your small account into a big account is to start small, which you're in luck because if you have a small account, then you already are small. There's no other way to start. But of course, nobody wants to hear start small because everyone wants to immediately be swinging around billions like Axe and billions. Big money quick, that's the name of the game. And it can happen relatively quick, just not as quick as, your first order you make $1 million. But here's the thing you gotta realize, you have an advantage being small right now. It's just like small people on airplanes, the tiny Tims. They have a huge advantage because they could fit anywhere. The seats are just fine. Bigger people have a problem in the seats, but for these guys, the seats are just fine. They're super comfortable because they could even fit in the overhead compartment. It wouldn't matter. Smaller means a larger comfort advantage. And actually by being small in the stock market, you get that same comfort advantage because when you're small, okay, you're not going to gain a bunch of money like a huge dollar amount. There's a cap, right? But you're also not going to lose that much because all the portions are smaller. And you know what the benefit of being small and losing small amounts is? A smaller level of stress. And stress and emotions and panic, that's the #1 killer of traders in the stock market. So by starting small, you're already avoiding that. And in this small stage, with this small amount of money that you're starting with, you are free to test around and develop your strategy. Now the goal isn't to stay small, obviously we want to get bigger, but this initial testing that you're about to do is basically simulating what you can do at a larger scale. So it's in this testing area that you work out all the kinks. It's the same thing as like a software company. They're not going to release new software to a bunch of people at once. They're going to have a beta testing period. That way they could find all the bugs and work it out and make sure that, it works and it's effective. So there's a few goals that you should have in this small stage. And the main goal is to find out if you're even profitable, if you have an edge in the market. And it sounds obvious, but a lot of traders don't even look too far into this. They just think, oh yeah, I'm profitable. And then they get smacked and they blow up when the market turns. So what you got to do is simulate a lot of trades with the smaller account and go through multiple cycles in the market. That means you're not just going to trade through a cycle when the market is going straight up, because then, yeah, if you got a long strategy, as in you're buying stocks, then it's going to look pretty good. You're going to think, oh wow, I'm great at this. You also need to trade it through a down period to see how it survives through that. And I'm talking about this in general terms. The actual time frame is different depending on your strategy. Like if you have a really short-term strategy, you might be able to test the whole thing in a few months because you're getting enough up and down cycles within a short period of time. If you have a longer-term strategy on a longer time frame, then it might take longer to test. Either way, you should be recording your results the whole time. Your very own trading diary. You could draw pictures, you could hide it in a special place, whatever you want to do. But eventually you should have a list of stats. You should know how many wins you've had, how many losses, and from that you could calculate your win percentage. And then you should also know how much you're making with your largest win and your largest loss. That way you know the range of your strategy of what could happen, and you also know if it's profitable. Like if you're winning $2 for every $1 that you lose, that's not bad, right? And then the biggest thing that you want to measure is your drawdown. And your drawdown is the amount you'll lose from the peak amount of money in your account. Like when everything's going well, you're making a bunch of money, to the bottom, which is when you go through a losing streak, how how much do you lose. And that percentage is your drawdown. So it's from the peak amount of money in your account to the low. And once again, you're testing the range of your strategy. So you're trying to figure out really what is the volatility? What am I doing here? And your strategy's volatility is just like how big are the swings going to be in the account? Because like I said before, your emotions and the stress and all of that, that's what screws up traders more than having a good strategy. Because really simple strategies tend to work in the stock market. So beyond that, it's just up to you to actually follow it, right? And we'll talk more about this volatility bit in step 2. But before we get to that, you also got to know with all this testing is the risk of your strategy blowing up. Because the worst thing is when you think you're profitable and everything's going well, just like if you only tested your strategy in a big bull market and then the market changes and you blow up. That's a big thing in this. You don't want to lose all your testing money. You don't want to blow up any of your accounts, even in the future. Because when you blow up an account, then you're starting from zero again. You're like screwed. You got to build up capital. And capital building is not easy because you got to slave away at that job that you hate. So wouldn't you rather protect your capital than have to go back to your job? Yes, I would. And then once you've done all this testing and you know your strategy works, that it has an edge, you can move on to step 2, which is sizing up. Now we can start the acceleration process, the process of growing that tiny account into a big account. This is the part where we can start turning up the amount that we're betting and therefore turning up the amount that we're getting out of the market, our profits. Because to scale your strategy, you want to be able to take bigger position sizes. See, the truth is, if you're looking to grow your account fast, then that means you're going to have to take on more volatility. And I'm talking about volatility in your account. So that drawdown that I told you to measure, well, if you start increasing the amount that you're going to bet on each trade, that drawdown is going to become larger. And then you got to ask yourself, can I handle a huge swing? As in multiple 50% cuts to your account. That's how volatile it can get. And it's not necessarily easy. You need balls of steel. And the faster you want to grow, the more of that volatility you're going to have to take. But fortunately, because you did do your calculations in step 1, you can decide how much of that volatility you want to handle. And that will determine how fast you can scale. If you know your average win and losses and drawdowns and win percentage and all that, you could type in this new position size and see how the numbers change. And the biggest thing you want to focus on is that new potential drawdown and new biggest loss potential, because that's what screws people. Again, the emotions. As soon as you see that hit in real life, you're like, oh man, I've been used to 10% drawdowns. All of a sudden, this is 30%. You start sweating and acting crazy and you have a good chance of screwing yourself. Because what you never want to do in trading is break your strategy. You always want to follow it once it's set. But turn up that volatility and it becomes a lot harder. Even if you think you'd be fine with it. You're like, yeah, I got control of my emotions. Well, you don't actually know until you see it. You got to experience it. See, I've seen it and I've experienced it. And I said to myself, you know what? I have small balls and I'm happy with them because they fit perfectly in my pants and I don't want all this volatility. So the strategies that I use now, they don't grow as fast, but they're also not as volatile. So I sleep like a baby at night, a baby with baby balls. And the other key is that I'm comfortable following it. And I'm comfortable following that strategy over a long period of time. And that's where the real returns are going to come from. It's still great returns, but not as high as if I took more volatility, but it's something I can follow, which is way more important than having that high return, high volatility thing that you're going to crap out on. Again, it's all up to your personal preference and what you want to do. And one more thing, when you are sizing up a strategy in this step, do it in chunks. Don't go 0 to 100 real quick. You got to take it step by step. Because like I said, what you think you could handle in terms of volatility is not what you're going to actually be able to handle. It's usually lower than what you thought. Not because you're weak or something like that. It's just because you don't actually know how it feels until you're in it. Because you might be like, oh, losing $50 at a time is way more comfortable than losing $500 at a time. And I don't want to deal with this anymore. Another benefit of scaling up slower is that you might find some errors in your strategy. You might find out that, hey, this thing actually doesn't scale up as well as I thought it did. There's some things that are breaking as I add more money and make my positions bigger. So doing it in steps will help you find those and fix those. And there's no shame if you decide you don't want the most volatile, fastest growing strategy. Can't look at it like that. Like, look at me. I'm happy. See? And I'm still making great returns and I'm taking advantage of compounding, which brings us to step 3. Don't be pulling money out of this trading account. You want to separate this account from everything else. You want to use this only to grow. The worst thing you can do is every time you make a little money, you take it out to spend it because you want to ball out with all those bottles and models that you see in all those trading ads. But that's not real trading. Real trading is sitting alone in a dark room all day just staring at charts. The only models are the investment models on Excel and the only bottles are bottles of Pedialyte so that you stay hydrated and don't die. That's what real trading is. So keep that money in that account if you want to grow it, because you got to take advantage of that compounding too. You need all your money working for you. You need those profits that you're gaining to go back into your account so you could grow them even more. And if you ever forget this concept, just go to this incredible compound interest calculator that looks like it's from 2002. You guys can keep your iPhone 11s and whatever, because I got this. This is all I need. Because look what I can do. I could type in a current amount, say $1,000, grow it over 2 years at 8%, press calculate, and I get $1,166.40. But hey, if I take that same amount, instead of 2 years, make it 10 years, what happens? It flips into over $2,000. Is this a lame example? Yes, absolutely. But the point of compounding remains the same, because if you have a more high activity strategy, then you're going to be compounding a lot faster than what I just showed in that old ass calculator. But the concept remains the same. Use your profits to make more profits so you can keep growing. And you want to know one of the best hacks to get your account growing faster? Well, we're going to talk about it in step number 4, which is have another source of income. So don't quit your day job. Day jobs are great. They're these beautiful things that give you money so that you could focus on trading while your living expenses are covered. You absolutely do not want to be trying to trade for a paycheck. That doesn't work. You can't be trading to try and make rent this month. Markets don't distribute returns like that. You can't expect a paycheck from the market like you do from your job every 2 weeks or something. Returns are unevenly distributed, which means they come randomly, which makes it really hard to use for a paycheck, and you will drive yourself crazy. Because when I was talking about the stress and everything before that comes with trading, well, that's 10x when you're trying to do it for a living, for a paycheck. That's stress that you don't need. And as we said before, if you're really serious about growing a small account, then you're not trying to take money out of there anyway. So cherish your job no matter how much you hate it, because the super secret growth hack I was talking about for your small account, you know what it is? Just add more money to your account. An easy thing to do when you have a good strategy and you know it's working to accelerate the timetable is to take that money from that sweet job you're making and throw it into your trading account. Not all of it, but your savings, because all of a sudden you have more capital to work with and your position sizes will get even bigger, and that means more profits. You'll get to your goals so much sooner when you're adding outside capital. And one more thing about that paycheck that you're going to get from your job, you are absolutely going to love it as a counterbalance to all the volatility you're going to experience in your account, because that non-volatile bi-weekly check that you get from your employer is going to feel amazing, especially when you're down big in your account and you're sweating all the time and you smell like cheese. That little employer check that you could always depend on, that's going to be your saving grace. 5th step during your journey is don't compare yourself to others. It will really drive you crazy, because we could all jump on the internet and go on Wall Street Bets or go on Twitter and see just ridiculous returns. But guess what? Most of the people posting those are full of it. And also, those things aren't sustainable. Like I was talking about blow up risk before. When you see insane returns that don't look possible, that's because those guys had huge blow up risk. And really it comes down to luck that they didn't blow up before they had those huge profits. And if you're a serious trader looking to grow your account and then continue to grow it over the long term, then you won't even employ a strategy like that, because eventually if you play it enough times, you will blow up. So don't be looking at that all day and then tempting yourself into betting bigger and then being all frustrated like, why aren't I as good as them? It's been so long. Because you'll just get frustrated and end up quitting, which ruins everything, right? So really you just want to ignore everybody else while you're in this process. And the last step, step number 6, is be realistic. Yes, you have the ability to make a ton of money in the stock market because you're smart and it's doable, but it's also going to take time and effort. Otherwise, everyone would be doing it and everyone would be super rich and no one would be working any real job. So understand that you do have the ability to do it, but that it's going to be a marathon and not a sprint, which is again why you don't want to go online and look at all that stuff, because it's just going to make you feel bad. So you got to keep that right mentality, because you wouldn't walk into medical school and immediately expect to start operating on patients. Doctors train for years. Why wouldn't the stock market be any different? Not saying it's going to take you years to become profitable, but it is a long-term journey. And remember, to help you out, we do have this explosive stocks checklist. It's a nice little shortcut into a strategy that does work for small accounts and can grow them pretty fast. So if you want that checklist, there is a link down below in the description and comments. You'll go to this page where you could download it for free. Do that today, shorten that time period that it's going to take you to grow that small account. And if you haven't already, subscribe to this channel because we got a lot more videos coming. Do that and I will see you in the next one. Stay fallible out there. Bye.